All right. Hi, everybody. My name is Seth Colby. I am one of the directors at the Hawaii Economics Association, and welcome to our webinar. So we do a webinar about every month, and this webinar we will be focusing on insurance and what's happening in the insurance market here in Hawaii and how the legislature is supporting that insurance effort. So we got two great speakers, which I will introduce in a couple minutes. But first of all, would love to just want to acknowledge and thank our sponsors, our corporate sponsor Tradewin Group, for letting us, just giving us the support to put on these events and these conferences, these events to facilitate what we believe is a really important conversation uh, going on in Hawaii about where we explore the topics that are really affecting Hawaii. And in this way, we can educate ourselves, we can inform ourselves, so we can make better decisions as a state collectively. So thanks again to Tradewin Group. Just as a reminder, next month we have another webinar. So we will be hearing from one of the, in my opinion, one of the most insightful legislators when it comes to housing. And so we'll be hearing from Chair Luke Ebslin, who is in the House, and his view on housing and how the legislature and how government can support more housing growth in the future. So please sign up for that. Also, we will be having the Hawaii Economics Annual Conference in September 9th. That's a Tuesday. The topic is insurance. So what we will be doing is building on what a lot of the discussion today. If you found this interesting but want to learn more, our annual conference is a great place to do this. One of the reasons we chose to focus on insurance is because it is a very complicated topic, and we wanted to take a whole entire day to break it down, understand what is going on in the insurance markets, how we can, different aspects of the insurance markets, how it's affecting the whole entire state economy, and what we can do about it as a state, and what we should expect, and how should we behave going forward. So we're going to be looking at that today, but we're also going to be looking at that at the annual conference. So please mark your calendars for that as well. As a reminder, we will have all participants are allowed to ask questions. So you can just use the question and answer button. You just click on that, write in your questions, and we will be fielding those at the end of today's conversation. So just as you can put in the questions anytime you want, what we're going to do is we're going to hear from our speakers, and then we're going to have the Q&A section in which we will address your questions. So without further ado, we have two fantastic speakers today. We have Scott Psyche, who is the former Speaker of the House and also is now acting Deputy Insurance Commissioner. He spent a lot of his time looking into this issue and is very knowledgeable about it. And we have the acting Insurance Commissioner, Jerry Bump. So both of these people are incredibly knowledgeable. They've been looking at what's being done, understand the market very well, and also what government can and cannot do in terms of supporting that, and so what we should expect. So without further ado, I'd like to invite both of our speakers onto the screen, and we look forward to hearing from you. We will be hearing from them for about, I would say, they're going to give a presentation 30 to 40 minutes, and then we're going to do a Q&A after that. So please stay tuned, and thanks once again for speaking with us, Jerry.
Sure. Thank you, Seth. Aloha, everybody. Let me get my... All right. Do you see that presentation on the screen now, I hope?
Yes.
Okay, great. Thank you, Mary. We'll go ahead and dive in. I know we're short a little bit on time here. We don't want to keep you too long. Just for reference, I'll be taking the first half, and then Scott will come on and take the second half. Let's see. Okay. Just want to touch on real briefly kind of the role of what the insurance division does. Some people know, some people don't know. We obviously administer quite an extensive amount of statutes that are, in the Hawaii Revised Statutes. So the insurance division is part of DCCA, the Department of Commerce and Consumers Affairs. We serve as the primary regulator of the insurance industry in the state. Our role is critical to maintaining stable, fair, and competitive insurance market that protects consumers while ensuring the financial health of insurers. Some of our core responsibilities are regulatory oversight as it relates to licensing. We approve and regulate insurance companies, agents, brokers, adjusters operating in Hawaii. We monitor the financial condition of insurers for what we call solvency monitoring to make sure that they can meet policyholder obligations. We also look into what we call market conduct. We review and investigate insurer practices to make sure that they treat consumers fairly and comply with Hawaii law. Additionally, we do rate and form regulation. So we approve or disapprove insurance policy forms and premium rates in certain lines of insurance. For example, homeowners insurance, auto insurance, and a few other lines of insurance. We have rate authority over that. Part of that process, though, is we're reviewing those rates to make sure that they're not excessive, inadequate, or unfairly discriminatory. Another core responsibility is consumer protection. So we're here to investigate consumer complaints related to insurance claims, policies, and marketing. We also try to educate the public through various outreach events, webinars, consumer guides. We also have a insurance fraud investigation branch, which is out there detecting and prosecuting fraud. Lastly, on a bigger scale, one of our core responsibilities is addressing market disruptions, which obviously we've been experiencing quite a bit lately. We monitor the availability and affordability of insurance products. For example, the condo insurance crisis that we're currently experiencing. We work to gather data, convene public hearings, collaborate with legislators and insurers to find market solutions. In more serious situations, we also can help with residual market mechanisms, which are essentially state-run insurers, in helping them get set up, and then also to promote new legislation to stabilize the markets. Go ahead and move on to the next slide. This is just another slide. It kind of further breaks down the insurance division. We're sort of organized into these 7 key branches that are, responsible for that regulatory thing. A few of the, statistics as it relates to the insurance division. So as of June 30th, 2024, we're on a fiscal year. We have 114,000 licensees. Our rate and policy branch reviewed 3,500 rate filings or policy and rate filings from insurers. We currently have admitted insurers in all lines of 1,403, with approximately 16 billion in direct premiums written in Hawaii. From that 16 billion in direct premiums, we've collected 213 million in insurance premium taxes that go into the state's general fund. Oops, sorry. We have a compliance and enforcement branch who works with the consumers to answer their inquiries and investigate complaints. They fielded 1,400 inquiries last year and investigated close to 400 complaints. And ultimately, through that process of working with the consumer and the insurer, we were able to save consumers $3.5 million. 2/3 of those complaints were related to auto and homeowners insurance. Our fraud investigation branch obtained 25 criminal indictments last year against individuals. Our health insurance branch handled 124 complaints related to health insurance, with about half of those related to denials of coverage or reimbursement timelines. And then lastly, our captive insurance branch, which obviously has a pretty significant economic impact on Hawaii. They have 272 licensed companies with 2.1 billion invested in Hawaii. For those who may not know, a captive insurance company can generally be described as a closely held insurance company that insures the risks and exposures of its owners and affiliates. The easiest way to explain it is if you have a large insurer, a large company, let's just say Nike, and they want to insure a certain aspect of their business, they form a captive insurance company to cover that risk. So sort of departing from giving you the overview of the insurance division and what we do, we're going to dive in a little bit about the current property insurance market, and specifically the one that we've been has been dealing with for a while now. Some of you may have attended the presentation a year ago, which I would think is actually kind of was approaching the peak of the hard market. So some of I have some stats on here. I'll go over the slide real quick. So admitted property insurance carriers. So out of that 1,400 insurers that we referred to previously, 671 of those are admitted property insurance carriers. So they can write insurance in the property lines. Only 3 of those 671 are currently choosing to write condominium master policies. So that obviously creates a capacity challenge. So, condominium associations across our state have experienced substantial increases in insurance premiums, with some seeing hikes of 300% to extreme levels we heard of over 100% within just a 1 year time. I mean, 1,000% within a 1 year time frame. For example, we heard reports of a Hawaii Kai association whose insurance premium rose from just under 400,000 to 3.3 million in 1 year. So due to those soaring premiums, many AOAOs opted for less than full replacement cost coverage. Probably at the peak of the hard market, approximately 400 condominium associations on just Oahu were carrying less than 100% replacement coverage on their master insurance policies. This underinsurance posed challenges for financing, as lenders like Fannie Mae and Freddie Mac require full replacement coverage for mortgage eligibility. Consequently, buyers may struggle to secure loans for units in underinsured buildings, leading to decreased sales and potential devaluation of properties. As I've touched on, there's only 3 carriers currently willing to write that type of coverage. 3 what we call admitted carriers, they're licensed in the state. And that's First Insurance, DB Insurance, and Arch are still active in this space. There's a few other insurers who may have previously sold policies and are continuing to renew existing customers, but they're not writing new policies. And then there's others who've just exited the market entirely. As such, AOAOs were having to turn to what we call the not admitted market or surplus lines market to get the remainder of their coverage. Those carriers, the rates they charge, we don't have any rate regulation over that. Okay, moving on. So kind of how did we get to this crisis? Obviously, I touched on Fannie and Freddie a little bit, but yeah, so I'll kind of skip over that a little bit in interest of time. Kind of going into this aging condo infrastructure. So, many of the Hawaii condos were built in the 1970s or earlier and have deferred maintenance issues. Insurers are concerned about water intrusion, roof damage, plumbing failures, and fire risk in older buildings. Properties with outdated systems, especially electrical and plumbing, are penalized with higher premiums or a denial of coverage altogether. As such, as I've already mentioned, there's several insurers have exited the condo insurance market in Hawaii due to the rising risk profile and reinsurance difficulties. I'll talk about reinsurance in a minute. With fewer insurers writing policies, the remaining carriers, they maybe not necessarily the admitted carriers, they charge the rates we approve, but the surplus lines carriers who are trying to fill that capacity need, they can charge higher premiums and limit it to stricter terms. This limited supply of insurance has created a coverage crisis for many of the condominium associations. On the global reinsurance market, that's kind of the next bullet there, master policies and reinsurance. Hawaii participates in that, right? The reinsurance, just for those who don't know, is insurance for insurance companies. So as those carriers who are willing to write that business in Hawaii, they don't want to retain the full 100% of the risk. So they go to what's called the global reinsurance market. These are really large, well-funded, capitalized companies who will structure arrangements to transfer some of that risk for obviously a cost. And, due to many factors, major disaster payouts, rising construction costs and inflation, limited capital and increased caution from those reinsurers, the reinsurers themselves had to raise prices or reduce capacity, which then ultimately trickles back down to the local insurers who are forced to raise premiums or decline risks in Hawaii. Lastly, we have natural disaster risk. My next slide will touch on that a little bit more, but I'll just mention, Hawaii is at a growing risk for wildfires, hurricanes, and flooding due to climate change. The 2023 Lahaina wildfire underscored the potential for catastrophic loss. As of 12/31/2024, $2.7 billion from insurers was paid out of a $3.5 billion incurred so far. Reinsurers and insurers alike have reassessed Hawaii's exposure, labeling it as a higher risk, which drives up prices or results in non-renewals. Lastly, I just wanted to share this slide. This is from the NOAA website that is soon to go away, unfortunately. They've kept track since 1980 to 2024, all the billion-dollar weather disaster events. And, 2024, they had 27 separate billion-dollar weather or climate disaster type events, which was the second highest total since 1980. The majority of those are what we call severe storms, tornadoes or, other types of severe weather events. Obviously this has a large impact on the insurance industry itself, leading to increased claim payouts, reinsurance becomes more expensive, and, insurers are looking to exit some of these areas that, they deem as more of a high risk. And just to put it into context, when NOAA started keeping track of this in the 80s and adjusted for inflation, in the 80s and the 90s, they would average anywhere from 5, events. And just in the last 4 years, we've averaged 23 events, with 27 in 2024. So the frequency and the severity of these storms continue to increase. At this point, I'll turn it over to my co-speaker, Scott Seike.
Okay, thanks, Jerry. Yeah, and thanks, Seth and Mary, for inviting us today. This insurance, as you said, it really is an important topic for us here in Hawaii, as well as throughout the United States. So kind of following up a little bit on what Jerry just discussed, we wanted to highlight a couple of recent factors that may or may not affect the availability and cost of insurance, of property insurance going forward. And both of these circumstances arose from the Lahaina wildfire. And the first topic is subrogation. The second is liability caps. So with respect to subrogation, subrogation is a legal doctrine that stems from the English common law, and it is a legal concept that is recognized throughout the United States. And subrogation basically occurs where an insurance company, who's the insurer, has paid its policyholder for a loss. At that point, it can then step into the shoes of its injured policyholder and sue the wrongdoer for money that the insurer has paid to its policyholder. So basically, subrogation is a form of reimbursement to the insurance company for money that it has paid in the event of a loss. So subrogation serves a couple of purposes. The first is to prevent a windfall by preventing injured policyholders from recovering twice, which is where they would recover money from both the insurance company and the wrongdoer. The second purpose is to ensure that the wrongdoer and not the insurance company ends up paying for the injuries. So following the Lahaina wildfire, as you saw in the media, Governor Green assembled a team that crafted a proposed $4 billion global settlement. As part of the settlement, the insurance companies were required to waive their subrogation rights against the wrongdoers, who were allegedly Hiko, Maui County, other large landowners, and other parties. But the insurance companies disagreed with this waiver provision and filed a lawsuit in the Hawaii Supreme Court. So about 2 months ago, the Supreme Court issued a decision, and it made a couple of rulings. And these rulings are hinge upon whether a judgment or settlement has occurred. And the rulings are as follows. So first, where there is no subrogation where the injured party received a judgment or a settlement, so presumably through a lawsuit. And in that situation, a property and casualty insurance company may not subrogate against the wrongdoer, and its only recourse is to file a lien to seek reimbursement from the policyholder. The second ruling is that if there is no judgment or settlement, then the insurance company may pursue subrogation against the wrongdoer. So within the Lahaina context, if there was no lawsuit or settlement, then the insurers could pursue subrogation against those who caused the wildfire. But since there were lawsuits and a settlement, then at this point, under the Supreme Court's ruling, insurers who seek reimbursement have one option, which is to file liens against their policyholders for the reimbursement. Okay, the second factor that topic that we wanted to mention today are liability limits on electric utilities where there is a catastrophic wildfire. And this is found in Senate Bill 897, which the legislature just approved a couple of weeks ago. The governor has not yet signed this bill into law. He has until early July to sign it. But as you know, going into the legislative session, there was a lot of concern about HECO's financial viability, especially in the event of future catastrophes. So Senate Bill 897 does a couple of things for all electric utilities and co-ops in Hawaii. It authorizes securitization of utility bonds, and second, it imposes liability caps for electric utilities. So first, with respect to securitization, electric utilities will be developing wildfire mitigation plans, and the cost of these mitigation efforts will be financed through bonds that are issued by the Public Utilities Commission. The bonds will be securitized and paid for through rate increases on ratepayers. The second component of Senate Bill 897 is liability caps. And This provision proposes to impose a cap on an electric utility's liability in the event of a future wildfire. Senate Bill 897 requires the PUC to adopt administrative rules that will create a mechanism to limit the financial liability of utilities in the event of another wildfire. And the PUC will need to take into consideration whether the caps apply for a time period or a single event, whether the cap should be a dollar limit or a percentage of the utility's market capitalization, the impact on the utility's credit rating, impact on rates, and the impact on other wrongdoers. And then specifically with respect to insurance, the PUC needs to consider the impact upon the insurance market, and second, the impact on indemnity, contribution, and subrogation rights of other liable parties. The bill calls for the PUC to adopt administrative rules to implement the liability caps. The rulemaking process is fast-tracked in the bill. Any challenge to the rules must be filed directly in the Hawaii Supreme Court within 30 days of the issuance of the proposed rules. And going forward, in the event of a wildfire, the cap amount is not subject to review. So this is going to be important for us to monitor both of these factors going forward. We need to monitor the impact of these decisions, subrogation and liability caps, and how they affect the availability and cost of property insurance, especially given the growing propensity for natural disaster and the growing nature of wildfire zones in Hawaii. So already we are beginning to see rate increases in response to Lahaina that are being slowly spread to ratepayers throughout the state. And again, this goes to the whole concept of insurance, spreading the risk through insurance. So Jerry, could you have the next slide? This is a map of wildfire zones in Hawaii. You may have already seen it. It's produced by the Hawaii Wildfire Management Organization, which I think is going to be able to continue to do its work because it's a nonprofit organization. But here you see the red zones in our state. These zones do not represent geographic zones that are recognized by insurance companies for rating purposes. I just wanted to show, to emphasize the rate of wildfire zones in our state. Okay, could we have the next slide, please? Okay, so about a year ago, the state government actually began to work on addressing the property insurance issue here. In June 2024, Governor Green appointed a task force and charged the task force with recommending actions to mitigate property insurance rates, particularly with the increases that we were seeing in high-rise condominium buildings. And I want to just do a shout out to thank those who served on this task force. The task force met between June and December. Senator Jarrett Keokalole and Representative Scott Matsuyoshi, the chairs of the House and Senate Consumer Protection Committees, were members, as well as representatives from the lending community, realtors, and the insurance industry. They worked really hard and put together some comprehensive proposals. So the first request from the task force was for the governor to issue an emergency proclamation, which he did on August 7. And the proclamation basically authorized the expansion of two entities, the Hawaii Hurricane Relief Fund and the Hawaii Property Insurance Association. And I want to just touch on these briefly in case someone's not familiar with these two entities, because they are going to be playing a pretty significant role going forward when it comes to stabilizing property insurance in Hawaii. So with respect to HHRF, in 1993, when hurricane insurers left the state following Hurricane Iniki, the legislature created the HHRF to issue hurricane policies. Fortunately, insurers returned, and so HHRF became dormant about 20 years ago. And kind of similarly, in 1991, the legislature created HPIA following the Kilauea eruption when property insurers left the state. HPIA primarily issues policies in lava zones 1 and 2. So HHRF is a state entity, unlike HPIA. HPIA is not a state entity. The emergency proclamation also authorized HHRF and HPIA to issue policies for condominium associations. And at the same time, Governor Green reactivated and nominated individuals to serve on HHRF, which was really important because we needed to get HHRF restarted right away. The task force also drafted legislation that became Senate Bill 1044. So could we have the next slide, please? Senate Bill 1044 was the Property Insurance Stabilization Bill, and the general purpose of this bill was to create a layer of insurance for condominium associations, although it has done a little bit more than that. So, as you know, high-rise condominiums are required to have master policies that cover the replacement value of their buildings, the full replacement value of their buildings. Currently, there are 3 insurers who provide master policies for condos, but only up to $10 million of coverage. So this means that a building with a full replacement value of $400 million must find $390 million of coverage through other sources. And this is kind of where we were seeing over the last couple of years the increased cost of condo insurance. It was with respect to this this outstanding balance with the replacement value. So Senate Bill 1044 authorizes HHRF to provide hurricane coverage to condo associations. The concept is that HHRF will use its existing $170 million balance to purchase insurance and then sell that insurance to condo associations. Associations will pay a premium, and those payments will revolve back into the HHRF fund. Over time, HHRF can generate more revenue to provide more insurance for other associations and property owners. So there are no direct taxpayer subsidies for this program. The details are being ironed out now, and HHRF expects to begin a limited rollout of coverage, hopefully in July. And the same concept applies to HPIA. HPIA will be provided with approximately $30 million to start up non-hurricane coverage for condo associations. Could we have the next slide? So I want to throw this in, since this is the Economic Association, I thought you'd be interested in this slide. This is the cover page of the credit report from S&P Global. As you know, the State Department of Budget and Finance goes through an annual credit rating with 3 vendors. So S&P is one of them. The other 2 are Fitch and Moody's. But this is, I wanted to highlight this report from S&P to show how important the HHRF is to our state. If you could go to the next page, next slide. So this is one of the, and this is all on the BNF website. But in November 2024, the S&P report identified the establishment of HHRF as a mitigating factor that could improve our state's credit rating. So that wasn't, another reason why it's really important for us to start up HHRF. Okay, could we go to the next slide? Oh, sorry. I guess I can go backward. My a lot of the time my comments don't really match the slides, but I wanted to mention one other program within the Senate bill, and this is the condo loan program. The bill has created a pilot program that is housed in the Department of Business and Economic Development. It's called the Condo Loan Program. And the concept is that this program will provide low cost financing to condominiums for repair and maintenance. And DBED is going through the rulemaking process, which may take about a year, which means the program can't start up until the rules are approved. But this is an important program because one of the issues with high-rise condos in particular is that the lack of regular repair and maintenance over the years has affected their ability to obtain insurance or affordable insurance coverage. Okay, so for the last slide, going forward, we just wanted to end the PowerPoint on a positive note going forward. By the way, my wife took this photo one day when she went for a run at Ala Moana, so I have to give credit to her for this background shot. So, I've always felt that when it comes to our economy, rather than incentivizing specific initiatives, our economic strategy should really focus on creating an environment where there is sufficient infrastructure, reasonable taxation, and functional government and government regulations. And insurance, I believe, is an increasingly significant component of this strategy or this approach. And we wanted to emphasize that going forward, we really need, as a community, to problem solve, because the cost of property insurance alone is not the end-all solution. The cost of property insurance is also driven by external factors, and we just wanted to list a few of those factors that we need to focus on going forward. So these are here's the plan. We want to provide more coverage through HHRF and HPIA. We want to implement the condominium loan program. We need to monitor the effect of subrogation and liability caps on insurance rates and availability. We need to devise ways to attract more insurers to Hawaii, and we need to make properties insurable, both high rises and single family dwellings and townhomes. So that is the end of my presentation. Thanks, Seth.
Thank you, Scott, and thank you, Jerry. This is really informative, and I really appreciate you guys walking us through and doing the basics. I learned a lot. If I could have both of you guys come on the screen, and I'll just apply you guys with a couple questions. And as a reminder, I see we have some great questions coming in through the question and answer function. So we will get to those in a little bit. And if people also have additional questions, please pose them there. But and this could be for Scott or for Jerry, whoever wants to just paint the picture. I was wondering if you could just paint the picture of the market evolution, right? You guys have talked a little bit about the hard market, which I'm not sure if you could explain what that means, but presumably life was good like 5 or 6 years ago in terms of the insurance market. Something happened, right? The Lahaina fires, things had come up, things were getting a little more expensive. And then what I feel like you guys are insinuating is we're past the worst part of it, and hopefully we're moving on to the next part of it due to the market just adoption and also some really important legislative accomplishments. So can you guys just paint a picture of the progression of the insurance market here in Hawaii, where we are, and just to two or three potential ways of thinking where we could go forward, and like what we should be watching to see, to understand where the insurance market will be going.
No, thanks, Seth. I can take the question. So I did mention hard market. I didn't go into a full definition of what that meant, but as economists know, sometimes the economy itself is cyclical, and the insurance market also can follow some tracks, what we call soft market or hard market. Hard market just essentially means where there is limited capacity, limited capital coming into the market, which then drives up costs and again, lack of availability. And that's what we were seeing. And it happened to kind of already be happening even before Lahaina. And in fact, we were already seeing, getting reports of limited availability of coverage. And it just also coincided with inflation, construction costs increasing. So we really, but it tends to be cyclical. So you'll see it in patterns where it will, usually a hard market won't last more than a year to 18 months or 2 years. And then, capital will flow back in, and then prices and stuff will, start to, stabilize. When I did allude to, just we don't see it in the division per se, but when we have conversations with the agents who are placing this business, they had said anywhere from July of 2024 to December of 2024 was the peak. And some of the renewals they were starting to see in 2025 were coming down from that peak. But a word of caution there is, the extreme rise from, what I guess the associations were paying to what they then had to pay, it's probably never going to go back down to what they were paying. In other words, some of it was, we're also in our talks with agents, they were saying that Hawaii was fortunate for many years, probably paying premiums that were below the true risk, below the true cost, for various factors. But so, and I think Lahaina did have an impact where they started to reassess, hey, wait, there's more risk here than we originally, forecast or modeled. So, that had an impact. I think, ways to go forward is, a lot of that's going to be studied, continue to be studied, because in that SB 1044, there is, the legislature has tasked our office with conducting a study on, ideas or, solutions to help stabilize the market, to not have these extreme swings in the future. One of the things that comes top of mind that Scott touched on was, making properties more insurable. So if we're talking about associations, it is really taking care of their deferred maintenance issues. If we're talking about, single family homes, some of that could be related to hurricane coverage. Where they live is another issue. Building in resiliency into the structure itself, or starting to look at, designs around mitigating even like fire risk. There's a lot of different programs out there in other states that we're looking into as well. Some were proposed through legislative bills this year, but did not pass. But I think we have to promote in Hawaii a more resilient community. I just saw something recently about one of the large home builders on the mainland using 3D printing as to build a large community of homes, and all of them are made out of concrete, and they're fire resistant, hurricane resistant. So I'm not saying that's going to happen overnight, but that's just something that obviously when we look at it from an insurance perspective, what can keep costs stabilized is keeping a good risk.
Thank you. That's really informative. I did have a question. So with the Senate Bill 1044, the HHRF can issue insurance coverage to condominium buildings, but that is only hurricane insurance, if I understand hurricane coverage, if I understand that correctly. How does that work? Like what percentage of the condo buildings do they need hurricane insurance versus other types of, like the master plan, which I guess is just the whole entire building?
Yeah, so the coverage itself for a building or an association is usually, the association just sees it as one policy, but it usually is broken into two parts. The one part is the hurricane coverage, and the other part is everything else. So what they call all other perils, whether that be fire, water damage, anything else related other than the catastrophic hurricane loss. The hurricane piece probably makes up anywhere from 40 to 50% of the total premium. And when we talk about associations, I just want to be clear, it's not just the high-rise buildings. We're also talking about townhomes. We're talking about single-family homes associations that get their coverage through the association itself. So it is impacting at different levels. That's what makes this a little bit complex. But you're correct. The SB 1044 did reauthorize or authorize the HHRF to provide the hurricane piece and authorize HPIA to provide the other piece. HHRF is a little farther along and does, as Scott mentioned, does expect us to come to market in the next month or so to start being able to provide that coverage. Associations would work with their agent. Their agent will be aware of how to get that coverage through the HHRF. There's certain parameters around that and underwriting guidelines, but for the most part, that should be available soon. HPIA, for the other remaining portion of the building's coverage, they're still working on their timeline. They were going through an IT infrastructure upgrade, and once that's live, they should be able to add on additional products to be able to start offering that as well. So, but the overall goal of 1044 was to provide more capacity to the market. When you provide more capacity, that should lower prices. It's not the intent of these state-run plans to be cheaper than the admitted market. We don't want to compete or drive out our few remaining carriers that are licensed to do business here. The intent is to compete with the surplus lines market. The entities we don't regulate, the entities that we don't have any rate control over, if that makes sense.
It does. So
Oh.
Go ahead, Scott.
I was just gonna add really quickly that the other layer of insurance in a condo is the HO6 policy, which is what unit owners are required to purchase to insure basically what is inside of their units. And what we were seeing the last couple of years was because the cost of master policies were increasing, some condo associations were placing increased burden on the HO6 policies and on the unit owners, and that would result in increases in the HO6 policy.
Interesting. Okay, so here's a question. Lahaina homeowners are trying to retain their insurance, but there is worry that the insurance policies will be dropped at annual renewal. Does the state have any plans to provide supplemental insurance to ensure the homeowners can secure insurance required to rebuild their homes and permanent mortgage financing? If not, what would the state need to do to have such a program?
So if we're talking about single family homes, currently HPIA, I know Scott touched on it already. Half of their business is that those homes that are in lava zone 1 and 2 on the Big Island. The other half of their business is for structures who can't get coverage through the admitted market or from a carrier. So if you do get non-renewed from your existing carrier, you first want to try to work with an agent, see if there's another. There are usually other carriers. There's a lot of more carriers in the admitted market for single family homes. So usually if you get non-renewed from one carrier, you can find with another carrier. It may not be as cheap. There may, but it would be cheaper than HPIA. HPIA, it can be kind of pricey, but they're not in it for a profit, but they have to go and buy reinsurance from that global reinsurance market as well. So they're really meant to be kind of an insurer of last resort. But there are issues with that too. They have certain coverage limits that they can cover, so they can only they cap out at I'm not sure what their coverage is at now. I think 450,000. So if you have a home that's worth more than that, you might have to get coverage from again from that non-admitted market or surplus lines market. So it can be a challenge. We do know that, you know, some people maintained their insurance, converted their insurance policy to, you know, when their home burned down, they still kept their coverage because they didn't want to lose access to that insurer. But it was a sort of it's kind of a different type of policy. You're not insuring the home anymore. You're kind of keeping it in a rebuild type phase. So it gets a little complex. Always kind of our thing is, you know, if you try to work with an agent, and if you're running into any issues at all, you can always call the insurance division and ask to speak with kind of our consumer area, and they can also try to assist with any questions you have.
Can I just add really quickly, Seth, that, you know, since we're looking at also the macro here, you know, going forward, it's going to be really important for the county governments and here in Maui County and how they make decisions on how Lahaina is going to be rebuilt. Because just rebuilding it the way that it was, you know, I'm not sure if that's the best course. I think that you know, because the counties control their building codes, they need to really take a hard look at where they're going to be allowing development and what kind of materials are going to be used for these developments. You know, and I always point to the example of lava zones 1 and 2. You know, the Hawaii County government issued building permits, zoned and issued building permits for lava zones 1 and 2, kind of knowing that there's this high risk in those areas. So the county governments need to are also part of the problem solving going forward.
And Scott, that's a great question. It brings up a big issue, right? Because at the county level, they kind of are, if we're talking about becoming more insurable, I would think the building codes are a big part of that, right? But are they responsible at all for like the insurance problem? So like maybe part of the problem is like at the state level, we're kind of trying to figure out the insurance market, but the county levels are kind of like more in charge of the risk and how insurable
Right.
actual
Yeah.
actual buildings are. Is that true?
Yeah, there's a disconnect here.
Okay,
I think that has to
interesting.
be addressed.
Hmm. And there, just a quick follow up to that, and from one of our questions, how does like we have a pretty strong historic building or historic preservation code, which so you're trying to maintain a lot of lumber based housing. How does that all relate to everything? Is that at the state level or is that at the county level?
Well, historic preservation standards are set by the state
Okay.
or the legislature. And the state historic preservation division is responsible for enforcing those standards.
So that is one area where the state actually has control over. You know, I'm not sure how much the historic preservation overlaps with how risky a building is, but that is someplace where at least at the same level, the risk and the responsibility is up there. That's interesting.
Yes.
Let's see. If insurance companies raise premiums to cover increasing risk for wildfires and other climate risk, how wide do they cast the net? In other words, would an insurance customer in Hilo be expected to bear the burden of somebody in Lahaina? And let's just further that out beyond the state. Like what happened when you guys showed all those natural disasters? They were basically in the center of the Midwest, right? Are we bearing the cost of what's happening in the Midwest as well?
I can touch on that a little bit. So directly, I guess the first example of if they're in Hilo, do they have to bear the cost? Directly, no, right? Your risk is calculated on your risk, where your home's located, what the risks are associated with your home. You know, how is it constructed, single wall, double wall, various factors that go into the risk for you and where you live. Indirectly, there is an effect. And that's kind of goes back to that concept of reinsurance. And so whether it was Lahaina or the Palisades fire in California or Hurricane Milton and Helene on the East Coast, all of those global losses affect what's called reinsurance rates. And now your carrier has to buy reinsurance because they don't have enough capital to issue all the policies they want. And so indirectly, those rates go up through that mechanism. I hope that answers the question. So it's not a direct, hey, you live on another island, but you're now going to start to pay for Lahaina's fires. No, not directly, but indirectly, you're going to be paying for globally what's going on, And the same thing goes with inflation and construction costs. It wasn't just all about, climate change and, increase in frequency and severity of disasters.
Great. Well, this is fantastic. I couldn't get to everybody's question. We are wrapping up, coming up to the top of the hour, but I wanted to give each one of you, Jerry and Scott, just one last, if you want to share one last message or communicate one idea to our audience before we close, what would that be? I'll let each one of you guys go.
You want to go first, Scott?
You can go first, Jerry. Well, I think, my point was that, thank you for holding this webinar, because it's really important for people to understand more about insurance. I mean, someone like me, we just pay our premiums and we don't really know anything beyond that. And I think but increasingly it's important for consumers and businesses and others to understand this whole insurance mechanism. And as I mentioned during the PowerPoint, we have some issues that we need to address, and I hope that we can work together to problem solve and try to find ways to make insurance more sustainable and affordable in Hawaii.
Well, that was well said, Scott. I think I'll just also close with, we here at the insurance division are, always working to try to balance, what's going on, whether it be consumer protection or, providing a fair playing field for insurers who want to do business in our state. So we want to promote that stability. In closing, obviously, if you still have questions and you weren't able to get them answered today, I do invite you to reach out to us. You can email us at insurance@dcca.hawaii.gov, or you can call us at our main number, which is 808-586-2790.
Fantastic. Well, I know this is a really complicated issue, and it's just so great to have two gentlemen that are very informed and very committed to solving this. And I know you've worked on this for many years. It is very evident from this presentation that you are you're working hard on this. So just as a reminder, I love this. I loved hearing from Scott and I loved hearing from Jerry. They are slated to speak at our insurance conference in September. So we were never going to be able to address all these issues in a 50-minute webinar, but we will go a lot deeper in our September annual conference. So we look forward to that. Thank you so much for participating and giving us a great presentations, Scott and Jerry. We really appreciate it. As a reminder, please use, I'm gonna just share this to everybody. We really appreciate your feedback. So if you could give us a feedback form for your participation, we would greatly like that. And also just another reminder, next month we will be looking at the webinar. We're having another webinar on housing and on the view from the legislature with Representative Luke Evelyn. So thanks once again. Thanks, Jerry. Thanks, Scott. This is great. And thanks everybody for attending, and have a wonderful day. Aloha.